sure you said very nice things, so great advantage of not speaking the language. We never know what insults are being passed over. But I do apologize for the fact that I'm going to have to speak in English. I think that I'm going to have to sit down given the way the microphone works, which is not how I normally feel comfortable. So, but I will do my best. I like to walk around when I talk and wave my hands, which is strange, I suppose. I'm going to talk about where I think the world economy is. I'm going to talk, I think, for about 45 minutes. There are lots of pretty pictures, so you don't just have to look at me. And then I suppose we'll have a discussion. I'm not quite clear how long this is supposed to go on for, but I'm prepared to keep going until you close it or you stop it. Maybe that will be better. Then I can stand up. I feel much better when I stand up. Okay, I'll put this off. So this has a strange title, as you can see. We agreed that it would be called Prospects for the World Economy, and it is Prospects for the World Economy. Although I have to say, for two reasons, it focuses rather on what's going on in the developed countries. First, because for the first time, I suppose, in my lifetime, the really big financial crisis is in the developed world, not in the emerging world. There have, of course, been financial crises in the developed world in the last 30 years, but nothing like this scale. So it's probably quite pleasurable for you to see such a mess being created in developed countries. And anyway, it's the story of the moment. And secondly, of course, I come from the epicenter of this crisis, more or less, so it would be strange not to talk about it. So I will talk somewhat about what it means for emerging countries later on, but a lot of this will be about the developed world. Now, I should say, as I have also already said, I've made Prospects for the World Economy the subtitle, and the title is Ants, Grasshoppers and Locusts, and I'm about to explain why. I wrote a column called Ants and Grasshoppers earlier this year. In fact, I wrote two columns, and my distinguished and wonderful colleague Ingram Pinn, who produces these marvelous drawings which always explain my columns so much better than I am able to explain them myself. So I often say that the words are redundant. I as it were, I illustrate the drawing. He provided this wonderful drawing, which I thought captured perfectly what I was trying to say about the way the world economy has been working, or an important respect in which the world economy has been working over the last 10 to 15 years, basically about 12, probably close to 12, since the end of the Asian financial crisis. And I'm going to come to that later. You will all remember, I'm sure, that there's a famous fable of the ant and the grasshopper, which the French insist was written by La Fontaine, but of course they're wrong, as always. It was a Greek fable, of course, apocryphally assigned to Aesop. And the fable is, of course, that in the summer the grasshopper eats and plays the violin or whatever, has a wonderful time, and the ant works very hard and accumulates stores, and then the winter comes and the grasshopper is cold and desperate and comes to the ant begging for food. And in the original fable, of course, which is honest and truthful, the ant says, no, you didn't work like we do. Why should we support an idle and feckless nobody like you, useless person like you? And the grasshopper duly went away and died. And the moral, of course, is that if you want to survive the winter, you have to work in the summer. And and of course, Disney got this story, and Disney, being Disney, of course, transformed it, and it all ended very happily with the grasshopper living with the ants and playing the violin to entertain them. But this is, of course, an American view of this story. Now, the important point I wanted to make in this is that in our economies, one way of thinking about the world in which we've been living, this is like all simple metaphors, of course only a simple metaphor, but is we have ants and grasshoppers. We have ant societies whose characteristic people are very industrious. They produce vastly more than they consume. They think that is a moral thing to be. And there are grasshoppers who consume vastly more than they produce. And that's basically how the world economy has worked. The difference, of course, is being human, we are mutually dependent. We are not, as ants and grasshoppers were in the fable, independent of one another. On the contrary, we are profoundly mutually dependent. The ants needed the grasshoppers, otherwise they couldn't have their export surpluses, and the grasshoppers needed the ants because otherwise they couldn't consume more than they produced. So, and then this story ended very, very badly when the grasshoppers found that the locusts, who are, of course, as the Germans have told us, famously the locusts described the modern financials. The Germans described, a German politician described the modern financial sector as just locusts, people who consume without producing anything, who simply steal from everybody. The locusts were, of course, the financial sector, and we discovered that the locusts had actually eaten everything up, and the grasshoppers couldn't pay the ants back. And the grasshoppers then couldn't continue to consume, and the ants suddenly discovered they hadn't got any more exports, and we had a world crisis. So this is the story of ants, grasshoppers, and locusts, and I am going to illustrate that. This is the only amusing part of this, I have to say, in what I have to say, because it's a central part. It's not the only part, but it's a central part, I think, of the story of the last 20 or 30 years. And, of course, the biggest and most interesting part of this is the ultimate grasshopper society happened to be, really not just happened to be, was, and this is really a first, I think, in the modern world, the last 200 years, the world's largest and most powerful country. And that changes everything in the way that the post-crisis world, in my view, is likely to end up. So what I'm going to do, with that little introduction, I'm going to go through the rest of this, I hope, reasonably swiftly so we can have a discussion. I'm going to start by talking about how we got here, why I think this crisis happened, which is, I suppose, putting a bit more concretely what I've just said. Then I'm going to talk about where we're going. Then I'm going to talk about some of the risks, what I think are some of the big questions that people have about what might now happen in the world economy. And then finally, very, very briefly, I am going to argue, just in a page or so, with one slide, that this crisis marks a very profound watershed, both because it reveals what has been happening over a long period in the transformation of the world economy and therefore the way the world works, and because of what it has actually done. And that will be the end of what I have to say here. So I've already explained this story already, so I don't need to go further in that. Just to remind you, as I said, the ants are the saving societies. The Chinese are ants. The Germans are ants. The Japanese are ants. The Norwegians, the Swiss, so lots and lots of ants in the world, ant societies. And by the way, just to give you round figures, at the peak of the pre-crisis period, the total surpluses of the ant societies were roughly $2 trillion a year, and that was approximately 30%, 30% of world gross savings. So we are talking an absolutely astonishingly large array of surplus savings going into the grasshopper societies, and the grasshopper societies, crucially, consumed it all. They didn't invest, they consumed. And the locusts made money out of intermediating between the two and left ruin behind them. And my basic thesis is if these relationships don't change, we're going to repeat crisis cycles probably quite quickly. And that's a fundamental issue for the future. So in that context, how do I explain the crisis itself? And to boil it down, incredibly boiled down, I think there were three elements that explain the scale of this crisis. Clearly the largest financial and economic crisis since the 1930s, and I think in many respects, as a financial crisis, the most devastating we've ever seen, because it was a period in which the core financial system of the world simply ceased to function. This didn't happen in the 30s. It really didn't happen in the 30s. The core financial system continued to function. Most banks, of the big banks of the world, continued to function. So why did this happen? I think I would argue there are three elements in this story. First, a set of ideas which were not entirely wrong, but were pursued to what turned out to be a devastatingly dangerous extent. And there were essentially two linked ideas which dominated Western economic thinking that related to this crisis. First, and crucially, I think, the idea that if you had stable inflation, this was not only a necessary, which it was, but sufficient condition for a stable economy under all circumstances. So this was a crucial idea, and this was validated in the eyes of many economists about what was called the Great Moderation, which was a long period in the developed world of stable growth and low inflation. And parallel with this and supporting this was a set of ideas round the notion of efficient markets, which essentially said, if you got this inflation story right, the financial sector would look after itself. You didn't really need to worry, because as Alan Greenspan famously said in his testimony to Congress when he admitted he got it wrong, shareholders should look after risk properly. Provided they did so, nothing could go wrong. That's number one. Number two, some quite extraordinary economic phenomena of the grasshopper ant variety, the emergence of quite astonishingly large global imbalances, extraordinary official reserve accumulations which were driving those imbalances. So this was not just a result of market forces, it was a result of deliberate policy decisions, themselves a response largely to previous financial crises, the Asian financial crisis, which persuaded many people around the world in emerging countries that they had to stop capital imports, or if they were going to get capital imports, they had to recycle them out as reserves. This contributed to an environment of exceptionally low real and nominal interest rates, and that in turn drove quite a number of investors, particularly long-term investors in the developed world, to search for higher yielding, safe assets than the standard menu of government bonds and AAA-rated corporate securities were providing. And that then led to the third area, which is that the financial sector, the modern financial sector, generated a simply staggering quantity of just the assets people were looking for. AAA-rated or pseudo-AAA-rated assets which had the property of being higher yielding and apparently safe, and therefore meeting the regulatory requirements that they wanted and investor requirements they wanted to meet. At their peak, as Lloyd Bankfine has pointed out, there were 64,000 AAA-rated securitized assets out there. This in a world where there was essentially no more than about 12 AAA-rated sovereigns and about the same number of AAA-rated corporates. And this then leads to the whole regulatory question, where basically what I think we saw was a combination of acts of commission and omission. Acts of commission which encouraged institutions to take risks, particularly in the housing sector, and acts of omission which ignored essentially the creation of a vast structure of off-balance sheet risk-taking which was attached to the banking sector, but for which the banking sector was not held directly responsible. And as Hyman Minsky would put it, and his name has very much come back into fashion, a famous Keynesian economist, Chicago Keynesian economist, a unique phenomenon, who died in the mid-90s. I have retranslated, this is not a phrase that he used, but I think it very much captures his thought. So a series of successes driven by these phenomena, what seemed an incredibly successful system, bred excess, and excess bred collapse. There are two features of the ant phenomenon, what I call the ant phenomenon, I want to stress, because they're very, very interesting in the terms of the way the economies of the world have worked and continue to work. The first of these is captured in this chart, which shows net corporate savings, basically non-financial corporate savings, in 4 major developed countries, the US, UK, Japan, and Germany, since 1995. And by net corporate savings, I mean, quite simply, the difference between retained earnings and investment. So the surplus these corporations were generating over their need for investment. And the thing you will notice is that from 2002 onwards, these sectors were all surplus. That is to say, the sector which normally uses funds, which is the investment sector in our economies, which needs funds, is in fact generating surplus funds. It wanted to find good investments. Well, if the corporate sector wants to find good investments, where can it find them? Well, the answer to that is actually, when you think about it, with great difficulty. It's very difficult for the corporate sector to find someone else that will invest more wisely than it does itself, and it failed. And I will come in a moment to how it did. And then there was the second aspect of the ant phenomenon. So the corporate sector in our economies became ants, and they have remained ants in this sense. They have been saving more than they've invested, and it's become much bigger since the crisis. And the second thing was, as I've said, the emergence of the global imbalances, which I think is very, very striking in this chart, these are shares of world GDP from the IMF. There are 3 major surplus groups. There's the oil exporters, there's Germany and Japan, there's China, which is basically this, and then there's the rest of the world. And you can see the explosion of the Chinese surplus. And the aggregate surplus rose from 0.5% of GDP to close to 3% of world GDP between 1996 and 2007. So an immense increase in the surpluses available from investment, almost all of which ended up in the US. We've got completely used to this phenomenon, but it really is quite extraordinary and really very weird. Nobody among economists would have ever expected until this happened that in a period in which we've opened the global capital markets, the theory behind this being this would allow savings to flow from relatively rich countries to relatively poor countries with vast opportunities. They would have expected, if you'd asked them 10, 15 years ago, that the overwhelming flow of funds would have been from the US, as it used to be from the UK, to the emerging countries. Instead, they went from very much these surplus developed countries, as I said, Germany and Japan, but also from oil exporters and China, largely into the US. But I've already told you that the non-financial corporate sector in the US was cash surplus. It didn't need this money. It had nothing to do with this money. It didn't want the money. So where could the money go? There were only 2 places it could go, to households or the government. And it started off it went basically half and half to households and government. I don't have the time to go through all these balances of the economy, but it went half and half to households and the government in the 2000s, and then the household sector collapsed. The non-financial sector got even more prudent, and now it's all going to the government. So, and by the way, I've got many things wrong in this, but this is one thing I really got right. 5 years ago, I predicted that the fiscal deficit in the US would, when this blew up, end up between 8 and 10% of GDP, and all my American friends said I was a lunatic. But it happens to be true. It was necessarily the case. This is a quite weird phenomenon. Essentially, poor countries have been saving vast amounts of money, which they've invested in the household debt and the fiscal debt of the world's richest country, and it's all gone to waste. It's a massive waste, and it also caused an enormous crisis. As I said, these flows of funds from the emerging countries didn't just happen. they were in very significant measure driven by government capital outflows. This is what the rise of foreign currency reserves, and I haven't even put in the sovereign wealth funds, actually means. As you know, Brazil is a small player in this. I think you've accumulated $200 to $300 billion, something like that, which in the context of 250. Sorry? 200. Okay. The total accumulation of global foreign currency reserves between the beginning of 1999, so the end of the Asian financial crisis, and today went from 1.6 trillion to now basically $8.4 trillion. So you can say that Brazil was a relatively modest player in this gigantic accumulation of government-owned funds. The governments have controlled these capital outflows as a part of a well-known policy system. They kept exchange rates down, they have promoted exports, they've generated current account surpluses, and they have invested the proceeds in the liabilities of these governments in the developed world, and above all, of course, in the liabilities of the U.S. government. It's been a I used to joke when I did these lectures in the Americans 2 or 3 years ago, for the Americans, this is the largest official aid program in world history. Incomparably the largest. Now, who has done all this? Well, of course, as we know, the biggest single chunk is China. China's reserves have increased by $2.4 trillion over this period, and China's reserves are now equal to 50% of China's GDP, which is the second largest in the world. This is incredible. The Chinese government has invested a sum of $2.5 trillion in the liabilities of the government, predominantly of the government, of its own principal rival. It is a quite astonishing and I think unprecedented phenomenon. The developed countries have accumulated a bit. That was predominantly Japan. There's been an accumulation by Japan. Not much by the rest of Asia, a bit. And then there are other developing countries which are mainly oil reserve countries, oil producer countries. Now, with this flow of funds coming into the developed world, it's the counterpart of the grasshoppers and the ants. The grasshoppers have had a fine old time. I'm just because of lack of time, I can't go through all the other countries involved. I'm just focusing on the US because it's the biggest part of the story, and of course the US is the world's most important country. This shows the sectoral ratios of debt to GDP. This is gross debt to GDP in the US since the 1970s. So you've got a long period of relative stability till 1990. Government debt went up and then down again in the Clinton era, and this is where it was just before the crisis hit. There are three aspects I just point out. The non-financial corporate sector leveraged up a bit from about 50% of GDP to 80% roughly. The non-financial corporate sector in the US is in fact more leveraged than ever before, but that leverage is very concentrated in those sectors where private equity has been very active. Most US corporates are not very highly leveraged, some are very highly leveraged. The second element is the household sector, and here there really was an explosion of debt. Roughly speaking, household debt to GDP doubled in 10 years to levels never seen before in US history. The US household sector, and that was, of course, driven by the housing bubble. Exactly the same phenomenon in the UK and a number of other developed countries. The final part of the story, which I think is incredibly interesting, is what happened to the financial sector. Now, here we're talking about the financial sector's debt to itself. And it really is a measure of the complexity of the relationships within the financial sector as debt and assets and debt compounded across institutions. And this basically grew from about 18% of GDP in the late 70s to a peak of 120% of GDP. The leveraging of the US financial sector, and by the way, this is just part, the story for the UK is worse. It increased to 250% of GDP, and nobody understands, in my view, this structure anymore. You saw that once the crisis hit, these debt ratios started to fall, and the government started leveraging like crazy, which is exactly what you would expect. That's, I think, the background to this story. Now, let me just talk a little bit through the crisis itself, and I hope I'll accelerate. In a paper and then in a book published during the crisis, but the paper was published before the crisis, Carmen Reinhart and Kenneth Rogoff predicted a massive financial crisis in the developed world. They said that the developed world as a whole, and particularly the US, looked to them very much like the same condition as other developed countries. They weren't just looking at emerging countries like Japan, the Scandinavians in the late 80s, and they predicted a huge crisis. It was one of the great calls in economics. They were completely right. They also said, more or less, well, this is what happens when you get a crisis like this. And they went through it very neatly, and I hope you can sort of see it. I won't go through it, all of it. You get huge housing price declines averaging 35%, equity prices collapses, output tends to fall by about 9%, unemployment rates rise by an average of 7 percentage points, government debt rises by an average of 86% of GDP, and the main cause of this is not bailing out in the system, but simply the result of the recessions. Their predictions of what would happen, I wrote about this quite a bit before the crisis, turned out to be fantastically accurate, but actually, surprisingly perhaps, we didn't do quite as badly as they predicted. The end results, I won't be able to go through all of this, were not quite as bad as we expected. The only country actually that had a GDP collapse as big as they predicted was Japan. This is Japan's GDP collapse from just before the crisis, and you can see their collapse was exactly 9%, just what you predicted. Most countries had much smaller GDP declines. France and the United States had GDP declines of only, quote-unquote, 4%. Nonetheless, if you look at these 6 major developed countries, these are the biggest developed countries there are, so I focused on them. You can see 2 things. First of all, they had really deep recessions. This shows the GDP from the beginning to the latest period, which is the second quarter of 2010. And the France and US just 4%, Germany, the UK, and Italy shrinkage of about 5%. The second thing I would like to stress, it's very crucial, is not one of these countries is even today back to where it was before the crisis. So if you define a recession in relationship to the starting point, which is certainly the least I would do, I would say that every major developed country is still in recession. It's true that in the US case, GDP is now rising. In most of the other cases, GDP is rising slowly, but really quite slowly. But we're still below where we started. And by the way, it is very noteworthy and I think remarkable that despite being the epicenter of the crisis, the US decline was the smallest of these countries. It had the smallest recession. And I think the main reason for that was simply the scale of the policy intervention. One thing you will have noticed there is the theme of my whole talk is that the export countries, Germany and Japan, which had no domestic financial crisis because the Japanese had one already 20 years ago and Japan had no financial crisis, had recessions just as deep, if not deeper, than anybody else. And the reason of this, of course, is the ants need the grasshoppers. If the grasshoppers don't spend, the ants don't have a market. And that's what happened to them dramatically. Now, how did we deal with this crisis? Well, essentially, we dealt with this crisis by throwing every policy instrument at it in a way that has never been seen before, the most dramatic policy interventions ever. And I've just shown here from the IMF a chart which shows the average fiscal deficits for the advanced countries, the emerging countries, and the world. And you can see that in 2009, the average fiscal deficit in developed countries hit 9% of GDP. Just to put this in context, there is no point in the history of the developed world, including the Great Depression, when they ran deficits of this scale other than in world wars. This is wartime finance. So in this respect, by the way, the Reinhart-Rogoff predictions will turn out to be completely and utterly correct. And a consequence of this, which you can see, this is public debt over GDP going back to 1950, is that we after a long period of slow rise, we've suddenly seen an explosive rise in fiscal debt in the developed world, rising back more or less to where we were in 1950. The way I would put thinking about this is we all knew we were going to have a big fiscal problem as our economies aged, but the crisis has brought the problem forward at least 10 years. So we're already there. And the implication of that is, of course, the main story in the developed world in fiscal terms is going to be trying to tighten it for a very, very long time. The actions taken on fiscal policy, on saving the financial system, which was comprehensively socialized, completely, the whole liabilities of the financial system were socialized, again, something that has never been done before in these countries, and the monetary policy, which is more aggressive than at any time in world history in terms at least of interest rates and quantitative easing, is that what seemed to be a depression was stopped. And you will see here, I've shown the growth of world trade, annualized 3-month moving average over the previous period. You see the staggering collapse of world trade that was in process in the end of 2008, in the beginning of 2009. At one point, trade value was falling at an annualized rate of 60%. It's just unbelievable. That was reversed successfully, so we avoided the Great Depression. And industrial production has a very similar story. Everybody went down. Everybody was coupled during the worst of the crisis. At the worst, in the advanced economies, industrial production was falling at an annualized rate of 30%. Again, this was stopped. So this incredible policy action did help, but we've ended up with a very deep recessions and incredibly expensive interventions with, as I've said, the liabilities of the core financial system nationalized, monetary policy quite unprecedented, and fiscal policy on a wartime footing. And that's basically how we go. So with that on how we got here, my ants and grasshoppers, let's talk about the recovery. For the world as a whole, I think it's fair to say we have a fairly fragile recovery, because the developed countries could go back into recession quite easily if there were another significant negative shock. I'm not predicting that, but it's perfectly possible to imagine, particularly if fiscal policies tighten very quickly and the private sector doesn't respond. We have a very strong recovery in the emerging world, especially Asia, clearly in Brazil. I'll come to that in a moment. It's not too bad in the US. It's incredibly weak in Europe. So if I look at, this is, I think, quite an interesting picture. If we look at where what might happen next year, this is the consensus forecast. So it's an average of forecasts. Since I don't believe in forecasts, I think the most interesting thing is just to look what people think might happen. And the interesting thing about these consensus of forecasts for 2011, which I've shown for successive months, January consensus, the June, July, and August consensus, is they're all getting mostly worse. People are getting more pessimistic, and that's particularly true for the US, UK, Japan, and the Eurozone. It's least true for Germany. Germany, because of its export success towards China, has done relatively well. Spain is in a tremendous recession. As you can see, with growth now expected to be no more than 0.5% after a very, very deep recession. Second thing that is worth noting is, again, what I've said before, the US clearly looks the least badly off of these major developed countries. Now, the emerging world looks dramatically different. These are successive consensus forecasts for major emerging countries. So I've got China, India, Russia, Eastern Europe as a whole, Brazil, Latin America, and the world. The Brazilian picture looks absolutely sensational. I put it in the too good to be true category, but you're going to tell me it isn't. But anyway, there's been an absolutely staggering upbreaking of the Brazilian prospects for next year over the last 8 months. But quite apart from the general optimism that you see for the emerging countries and for the world, obviously the other difference is simply the level of growth. What I was showing in the previous picture was growth between 0.5% at worst and 3% at the best, and here we're talking about 10% down to, in the relatively weak cases, Eastern Europe 4%, Russia at 5%. So that's a very, very striking contrast. This is a recession which has really hit the developed world dramatically. Now, I want to put this in slightly longer term context because I think that's very important and very interesting. It sort of presents a better picture of where we are, I think, which is this. This is IMF figures of growth in the advanced economies, the developing economies, and the world, which is the yellow line, since 1970. You can see that this was a very deep recession. You can see the blue column, which is the advanced countries going into negative growth, which is the first time since the war in 2009. That's not surprising. There are two other things about this chart which are absolutely fundamental, I think, and they are structural features of our world. First, the developed economies are progressively growing more slowly over time. And second, the gap between them and the emerging countries has moved from really very little in the 70s and 80s to a ratio of about 2.5 to 1. There's an absolutely fundamental long-term transformation within the context of which this crisis occurred in the relationship between the growth of the developed and the emerging world. And here, just to put some more figures in, I've thrown in the major regions of the emerging world. So I put the emerging world growth as a whole, including forecasts from the IMF. These are the last April forecasts. I wouldn't expect them to be dramatically different. And they underline what everybody knows, that the Asian emerging countries are growing far faster than anybody else. And you can see where the Western Hemisphere in which you are is, I think, the second most successful region, growing on average 4.5%, 5%. And the other major big regions I have here, Central and Eastern Europe and Middle East and North Africa, again, in roughly that category. But this is a world dominated, of course, as we know, by the emerging world. And that fits, I think, because I really want to stress this very profoundly interesting long-term story about in which, the context of which this crisis happened and why I think this crisis is such a seminal, decisive event in world history, is the rapid decline of the weight of the G7. These are GDP at purchasing power parity, so the comparable prices. I think they're the least bad way of measuring the size of economies. This shows essentially the share of the G7 at purchasing power parity in the world economy. And in the late 90s, this was still not far short of 50% of the world economy. Not far short of the 50% of the world economy was the developed countries. And that was roughly where it had been for the previous 50, 60, even 100 years. Going up and down, but roughly where it had been. Today, it's about 35%. We have never seen such a rapid decline among these groups of countries in such a short period, at least not over the last century or so. The second thing that is quite interesting about this picture, by the way, is that the decline is least in the US. The fastest decline in relative weight in the world among the major developed countries is Japan and Europe. That's, I think, very, very significant. This is my developing country, emerging country G7. So I've taken the 7 largest emerging country economies. I thought that would be quite interesting. It goes a bit beyond the BRICS. The BRICS are, of course, here. And I've added Mexico, Indonesia, and Turkey, which are the next 3. And you will see that their share has risen from the beginning of the 90s to 18% now to about 33%. I'm afraid this increase in the share of these leading 7 countries is all China and India. And the Chinese phenomenon is simply staggering. Simply staggering. It's gone from 4% of world GDP at PPP to 12 in those 20 years. And the final thing I do to put this, I thought it would be nice to put this in global context, the catch-up process, which this is part, is I put in GDP at purchasing power parity relative to the US for 3 of the great Asian catch-up stories, Japan, South Korea, and China. And I put in Brazil and India. And the main reason I've done this I put in Brazil, so you just know where Brazil fits in terms of relative GDP per head to the US, which over the period has been roughly level pegging over the whole period. Japan had a tremendous success with unbelievably rapid growth. This is a log scale, so it shows the rate of relative growth. And it peaked in 1990 and has now been in slow relative decline. Korea has continued incredibly rapid growth and will pass Japan in about 5 to 10 years at this story. But a really important part of this is China and India. And the important thing about China is, the really important thing about China is that it is following the same relative catch-up growth as Japan and Korea at their best, despite being the world's largest country. And today, it is still only a fifth of America's levels. It is still poorer relative to the US today than Japan was in 1950. So on that basis, this is not over. India, by the way, is half as much again. So I think we have to assume these growth processes are definitely not over. So I've talked about the short-term growth potential. I've discussed that. I've talked about the massive divergence between emerging countries and the developed countries in terms of growth potential and likely prospects. And I've emphasized that what I think is the bigger part of this story is that the rise of the giant Asian countries is still at a relatively early stage. And the transformation that will bring about is one which we will experience in this century and will be, I think, absolutely profound. Let me finally conclude, since I've now spoken for 40 minutes, according to my watch, so I will speak for perhaps another 5-10 minutes. What are the risks in the story I see? And I'm going to look at just four. There are many things I'd like to talk about. The first is the story of the global imbalances and the risk of protection, currency wars, in other words, what has been in the papers very recently. Then I'm going to talk about the question which really burns people up in markets, is the immediate risk inflation or deflation, which of these are in prospect. I'm going to talk, which is obviously related to the second, about the possibility of sovereign defaults. And then finally, just for fun, I will ask the question whether the Eurozone is going to disappear. What is the crisis? What is the potential for the crisis in the Eurozone? Because if it did, that would certainly have very, very large repercussions. So just focus on those. And so first of all, the imbalances issue and protection. There's a lot of discussion of protectionism. There always is in a crisis. But if you look at this crisis in terms of the protection against particular imports which are more competitive, the sort of classic protectionism, there's been very little of it. The really remarkable thing is how little there is. The big issue is not that sort of protection. It's macro protection. It's the desire of the US to get its exchange rate management back under its control, which it has had taken away from it by China. And the US doesn't like this situation, and those of us as old as I am, there are one or two people here in that, maybe even one or two older, will remember that a very similar tension existed between the United States, the Europeans, and Japan in the late 60s, and that led to the Nixon shock of 1971 and the beginning of generalized floating. The tension in the United States about the Chinese policy is greater. You will all have read about what has just passed the House, as I understand it, on currency intervention. This is going to be a very, very big issue. And I think there is a real likelihood, I wouldn't say a probability, but a real likelihood that the US may consider adopting aggressive trade policy measures against China if unemployment remains stuck where it is, about 10% at least, much higher non-employment, and if the Chinese currency doesn't start moving very sharply, and I think there's very little chance that the Chinese currency will move sharply. So the chances of a really big clash between the US and China on this issue are very large because the US, I think, has decided, or much of the US has decided, that it cannot go back, remain the world's borrower and spender of last resort, particularly if the principal borrower in the system is the US government. That's not something they want to sustain indefinitely. And if they're going to get out of that, They don't want to have another household spending boom, and the non-financial corporate sector will continue to be so prudent. They have to move out of the current account deficit that they've been stuck in for so long. So that's the first really big danger, currency wars and friction between the US and China. I think the risks there are really quite high. The second question is inflation or deflation. And my answer to this is very, very clear. There is no doubt to my mind that in the medium term, the risk is in the direction of deflation. We have massive global excess capacity. Core inflation for the developed world, as you will see very clearly here, has been declining now for quite a long time. In Europe and the US, core inflation is now down to roughly 1%. I think given the slack in these economies, which I've already shown, unless there are enormous spikes in commodity prices, the general pressure is towards deflation, not inflation, and that is going to be true even though there's going to be even more quantitative easing, the impact of which will be largely felt in the emerging world. And the reason that these can be combined is that the credit mechanism is broken, and therefore very large increases in the balance sheet of the central bank do not transmit into large expansions of bank money, which are the principal source of money in developed countries. So we're in a deflationary environment, and this is very strongly reinforced by this chart, which shows the total collapse of the growth of broad money, which is bad bank money in the major developed countries, essentially down to close to zero over the last year in the major countries in the US and the Eurozone. Here I put up M2, which is the principal broad money aggregate that the Fed follows. The third issue that I want to discuss is sovereign debt accumulations. We've got this massive debt accumulations, and there are some very big questions about how this will end. Will we have economic recovery, strong recovery and retrenchment? Will we have defaults? That could happen in the Eurozone because they don't have access to a central bank. Will we have inflation? Ultimately, I mean, in the very long term, or will we simply have various forms of financial repression to manage the public sector debt accumulations? As I've said, I'm nervous about the economic recovery. I'm not confident it'll be very strong, so it'll be very difficult to retrench fiscally. It's going to be very hard. Restructuring is quite possible in the Eurozone. It won't happen in the other major economies. We're going to have a medium-term prospect of deflation, but in the very long term, 10, 15 years out, inflation risks might become quite substantial, and financial repression is pretty well certain. I just thought I'd throw this in so you looked at what's happening to public sector debt in the major developed countries, and particularly in Italy, particularly in Japan, the UK, and the US, France as well. And you can see that the Reinhart Rogoff view of what's going to happen to public debt looks completely correct. And in the long run, therefore, public debt problems are going to become very considerable. Surprisingly, perhaps, or perhaps not surprisingly, given the depth of the recession, none of this shows in world bond markets. And if you look at of the major countries, the US, UK, and Germany, I've shown here, long bond rates are down between 2 and 3%, and these are historically almost unprecedentedly low rates since the 1950s. There's absolutely no worry showing in that respect. This is very, very different in the Eurozone, where I've shown that in the case of a number of countries, where I've shown the spread over bunds, you are seeing really already very significant fiscal stresses. And the big thing that has happened, I think, among sovereign credits is a very marked differentiation in the markets between the safe countries and the ones they've decided are unsafe, and the unsafe are all going to be pushed at some point or another into debt restructuring. And you can see in the Greek case this is more or less inevitable. The final thing I thought I'd just touch upon is the Eurozone, and I'm just going to throw up some ideas. Maybe you want to take it further in the discussion. First, I think the Greek bailout will fail. There will be restructuring of the debt. It's absolutely certain to happen, and that could trigger some real problems. And because if they restructure Greek debt, they may be driven to restructure other debts. This is going to put a very big stress on the system. More important in the Eurozone There has been a massive loss of competitiveness in the periphery of Europe. This massive loss of competitiveness can now be regained only by outright deflation, because it's a very close to zero inflation zone. So if Spain and Portugal, Italy, Greece, Ireland want to regain competitiveness, they need outright deflation. No significant developed country has managed significant outright deflation over a sustained period in the post-war period, and I don't believe these countries, which have highly developed welfare states, will manage it, and for this reason I think this crisis has just begun. This would sound like a British view, which is true. I always was concerned that this would happen. I wrote about this 20 years ago, that at some point some countries will be pushed into outright deflation, and it has ended up even worse than I thought, because the loss of competitiveness, which I don't have time to show you, was so severe. And that will put incredible pressure on the system, and how they will manage that, I don't have time to discuss. We could go into that later, but it's going to put immense pressure on the system. So finally, let me summarize what I think the lessons of these incredible episodes. This is an extraordinary episode in world economic history, with not only profound implications for the way the world economy works, but also for power relations in our world, the way the world will be structured. First, I think that this massive private sector leverage cycle, which I showed you for the US was very similar for a number of developed countries, is over. There is going to be a very long period of deleveraging, and it's going to be rather unpleasant. This is an environment which is going to have relatively weak demand and from the private sector, and I think this will remain the case for many years, very much as the Reinhard Rogoff playbook said it would. These have very long legacies. It's particularly severe because when 50% of the world economy is in trouble, they can't export their way out of it in the sort of way that, say, Korea could in the late 1990s. Secondly, the role of the US as borrower and spender of last resort, and I showed you the way the US balanced the whole system, that's clearly over. The US is actually no longer capable of playing that role. It is now the government that is playing it, and that's not credible. The third point is obvious one. Western countries, and particularly the US and the IMF under US control, as you will remember, went around the world telling all the world, and above all the emerging countries, that all you have to do is run your economy just like us, and everything will be wonderful because we know how to do it. And as you will all realize, this view of the West of itself and, of course, of the Americans has been utterly and completely demolished. Now, the implications of that is not that merely that it's a collapse of as it were, of American prestige, but because we are seeing this enormous rise in the Asian powers, and above all China, which is running themselves in such a different way, really is state-dominated capitalism. I think it is not only a decisive blow for Western prestige, it goes along with a profound shift in power away from Western domination. The West has basically run the world economically for centuries, and this period is now coming to an end. And this crisis, I think, is a very decisive moment in that event. It is, after all, important to remember not only the historic role of China as a great civilization, but that China, in addition, contains roughly 50% of as many people as the US and Europe together. Actually, closer to 80% more people than the US and Europe together. The 1, 2, 3, 4, fifth problem is the developed country sovereign debt problem is structural and permanent. The aging problem comes on top of this acceleration, which I've shown you in the debt profile. We're all going to, as I joke, in 5 years from now, we're all going to look like Italy. That's basically more or less how it's going to appear. If we are lucky, the Italians have very strong household finances. Very strong household finances. And the very last point, and I know I've gone over a bit, so I feel rather guilty about this. Anyway, the very last point is that while the emerging countries are doing very, very well, and the decoupling in that case is very profound, the developed countries are likely to have a long period of weak and unstable growth, and some chances, as they retrench very rapidly, they are going to be forced to retrench, some of them, some chances of moving back actually into outright recession. It is my view, and I'm writing about this again tomorrow, that this full adjustment will not occur if the emerging world doesn't drive most of its demand internally, and that means that China will have to, so that the Chinese emergency program of public spending, which was so dramatic in the last 2 or 3 years, will have to turn into a long, massive Chinese consumer boom. That is the essential ingredient, in my view, in a return to stable global growth in the economy. Whether that will happen is an open question. I hope that I have managed to at least illustrate my view of what's happened and why I think this really is an extraordinarily significant moment in world economic and financial history, as well as being a very impressive mess. That's really all I have to say. I'm happy to do my best to answer any questions. Thank you.